So the question is, how do you know where money is flowing? How do you know how long money has been flowing there? And how do you put this into a strategy, right? So I want to explore that. I want to look at the big picture and really understand what is and is not working, which is another way of saying where money is flowing. And I also want to look at the question and answer the question, when should we be concerned? How do we know when to be concerned? So I want to answer those two questions. I also want to look at an individual mining stock. I want to talk to you about that. And I have another bonus stock after that. So stick around. We'll get to all of that and more. Hey everybody, RC Peck here with Fearless Wealth. And the first thing I'm going to want to do is look at a big picture. And this is going to matter to everyone regardless of your age, because it's really going to give us perspective on what is and is not working. And the important part is how long we look at something. Like, is some stock going up or down for a week, whether it's huge up or huge down, or has it been going, down for 2 years? So let's do this. Let's first start over with this price chart right here. If you guys can look kind of over at that, let me tell you what you're looking at here. So I'm going to call this 5 assets. Whether it's 5 assets or 4 assets, go along with me. One of them is commodities. One of them is stocks. One of them is bonds. One of them is US dollar. We can call that currency. It's the most traded fiat currency on the planet. And then we also have gold. Now gold, it's really a sub asset, right? Because it's a metal, it's a precious metal. But I want to go with that right now because a lot of people want to know where gold is moving. So if you look at this chart here, this is a performance chart. And I start this performance chart before the COVID drop. All right. So this is what the markets are doing before COVID. Anyone ever knew how to spell COVID or anything like that? So what we have here is a bunch of squiggly lines. Specifically, we have 5 of them. So the red line, which is upper right at the end of this chart, the most recent part, that's commodities. And from the, before COVID crash, so the COVID crash was about a 35%. Now I'm going to use crash because the market fell 35% in 30 calendar days or 21 market days. That's very fast. The blue line, let me get my cursor in here if some of you can see it. The blue line is the stock market, the S&P 500, and that's up about 35% since the pre-COVID peak. Commodities themselves, and there's many different ways to manage a commodity portfolio. I would use an index. There's major indexes. You could use DBC or GSG or RJI, but we're using DBC here. And so there's the commodity complex, about 85%, 87% higher. Stocks are below it. Below that is actually gold. So even looking at gold pre-COVID high, gold's up about 20%. And then we have 2 more assets or sub-assets here. One is the dollar. It's basically flat. It's basically flat. And then the one below that is bonds, down about 6%. So first, let's just kind of take the big picture. This is before the COVID crash. So we have commodities up about 87%, stocks up about 35%, gold up about 20%, US dollar flat, and bonds down, what did I say here, 6%. So first of all, that's a long time period in the sense that there have been some huge behavior shifts in the economy, in the world. A 35% drop in 30 calendar days is a massive drop. Okay, now look what we do here. Then I'm going to go to the COVID bottom. So this is where stocks ultimately bottomed. It was only 30 calendar days later, and let's see what's happened here. So now commodities are up 150% from the COVID bottom. Stocks are up about 90% from the COVID bottom. Gold is up, I have to squint here. I don't want to squint, is up about 32%. So the order actually hasn't changed. The dollar, bonds are now above the dollar. Bonds are literally still down 1% from the bottom of COVID. So pre-COVID, they were down 6%. Post-COVID, they're down 1%. And then the dollar's down there. So let's do a quick takeaway. Money has been flowing into commodities since before the pandemic. So that is a significant amount of time. Now, that's probably saying inflation is here to stay. Now, when you look at the screen here, you can see the blue and the red line are fighting in the sense that there's a little bit like which one's going to be up. But you can see that since the blue line peaked, topped out, which was the end of 2021, the red line kept going higher, right? So commodities this year are up about 33%, depending on which index, maybe 35%. And the S&P right now is down about 6%. The Nasdaq's down about 16 or 17%. So money is still flowing into commodities, and not a lot of people own commodities. Not a lot of people own energy companies. Not a lot of people own base metal companies. So that's the thing I want you to see here. Also, too, what you want to see is, here's a ratio on the screen. This is a 35-year long price chart. And if the line is falling, okay, if the line is falling, that means you want to be in stocks. And if the line is generally going higher, you want to be in commodities. Or said differently, let me just put in some little brackets to help the brain kind of see. There's periods where, there are periods when commodities are outperforming stocks. Now, in the last 5 decades, so that's 1970, 1980, 1990, the 2000s, the teens, right? So those are the last 5 decades. Of those 5 decades, 2 of them, the 70s and the 2000s, commodities outperformed stocks. So it happens more than people believe, and it happens for longer periods of times, which people don't often understand that it lasts on, typically 10 years. Now, we have entered the 6th decade. We did that January 1st of last year. And so this is our 6th decade of the last 6 decades. Yes, I know. I'm doing some math for y'all here. And commodities are the place to be. They bottomed out in 2020, meaning they stopped underperforming to stocks. So part of knowing where money is flowing is really looking at the major asset classes. And the answer is money's flowing into commodities. Still, it started pre-COVID. Now, one thing would be kind of interesting is if we just took this back and we see at what point does commodities not outperform? So right here, it's a stubborn one. Even going back to January of 2019, commodities over that time period, 19, 20, 21, 22, over the last 4 years, commodities over that last 4 years, they matched the movement in stocks. And notice too, gold is still number 3 there. And then you just have these 2 down here, US dollar and bond, just kind of fighting for 4th and 5th place. So in many ways, over the last 4 years, this has been shifting and changing from a stock leading market to a commodity leading market. Okay. So that answers both how to know where money is flowing, how to know where to be investing, and it also answers about inflation, meaning inflation can stick around for the next decade. Now, is it going to be 8.5%? Probably not, but it is sticking around. Okay, so what I also wanted to do, let me get out of this frame. I just wanted to show a couple individual stocks, and let's do this. Let's just go to 5.5 years here. So let's put in FCX. FCX is Freeport McMoran. Okay, they mine metal-y stuff. So this is materials, specifically metals. And just notice here, it could not break above that. Like there was this double high. It just couldn't break above it, and finally it broke above it. And today, I'm recording this on Thursday after the market is closed. This is actually down 10%. Prior to today, it was up year to date about 20%, about 21%. So look, we know sellers used to come in here. What you will probably expect is for buyers to come in here again. And if you do see that, that means, and I'm just using FCX as kind of a placeholder for base metals, is that's going to solidify that this inflationary period is going to be around longer than not. The other one I wanted to show years ago, and I answered it on a video like this, but years ago, someone asked me if I had to get a buy and forget precious metal stock. Like if I just had to get one precious metal stock and literally I was going to buy and hold it forever, and I just want a portion of it in there, which by the way, a buy and forget is not necessarily a bad idea because it takes zero attention. But all things being equal, you want to buy and forget to have a tendency of wanting to go higher. So this is Franco-Nevada Corp. And this is the stock I had answered years ago as if there was just one kind of to have and forget about, it's FNV. And if you kind of notice here, now this is precious metals, not base metals. But if you kind of go back in memory to looking at Freeport, which is base metals, kind of the same thing is happening here where sellers came in at the same high. In this case, it was $180. And here FNV is now coming back down. Now it didn't fall as much as 10%, which FCX did, but you can still see some sellers are coming in. Now I say that because materials and energy, whether it's base metals or precious metals or farmland, here's a little bonus symbol here. This is companies that have to do with agriculture, AMD, Deere, and you can see that this was a lot of people coming in and liquidating their shares until everyone was done. That's also down 2.43% today. Here's the point. The area of the market that is winning, commodity-based equity part of the market, they're selling off a little bit. Now, they're selling off a little bit probably because the NASDAQ is down and there's other parts of the market that people are getting scared about. So they're kind of liquidating all of their positions or some of all of their positions to kind of manage their portfolio. But this is a very different correction than, say, if you had Facebook, right? If you had bought Facebook, the question really comes down to, why are you buying it? How long are you holding it? Now, I've talked to enough people about Facebook and they think Facebook's over. It's never going to be $1 trillion stock. I actually think it will. It's obviously fallen very badly, but let's see what it's down. It's down 51%. It could go all the way down to here, call it 60%. It's not going away. They have many assets that they have not monetized yet. So even if people are moving away from Facebook, they still have many other assets that they can monetize. And look, this is not too big of a prediction, but when you get one of these, I'm going to call it fallen angels, right? Growth stocks that is taking a big hit. What you'll notice, and let me zoom out here. What you'll notice is there's periods where they took really big hits when nothing else did. So Facebook here fell about 45%. So I believe that if you were to buy and forget you own Facebook and you would look at it 5 years from now. So what is it, 2022? So in 2026, 23, 24, 25, 26, in 2027, Facebook will have outperformed the S&P 500 by a massive margin. So just think of it this way. The S&P grows on average about 10% a year average. This thing will probably be up 20% average or maybe 30% average over that 5-year period. The key is you got to keep it. You got to keep it that entire time or it doesn't really work. Okay, so that's what we have. Let's kind of tie this together. And when I tie it together, I do want to bring up one thing, a stat that I heard this week about U.S. real estate. So in the 1970s, there were about 210 million people living in the U.S. And the U.S. at that time was building about 2 million homes a year. Today, there's about 330 million people living in this country. So let's just, for easy math, call it a 50% increase. Right? It's a little bit more, but we'll go with 50%. And there's about 1.3 million houses being built. So there's fewer houses being built with a lot more people wanting it. And the biggest part of our population in this country is first-time homebuyers, 25 to 35 years old. Now, that's going to be a pressure for people to continue to buy. The other thing is this. People are living in their house longer. It used to be 7 years on average. Now it's 10 years. People are living in their house longer. What that means is fewer houses on the market. Okay, that was just a little bonus there because housing does well in inflationary times. So wrapping this up, commodities are still a place to be. In hindsight, we know that it really started about 4 years ago. Commodities have been the winner COVID, right? The pre-COVID peak, and after that 35% fall. So they continue to be the place to be, which means you're going to want a portion or a noticeable portion of your portfolio being allocated to commodity-based equities or just commodities themselves. So we have that, and that's kind of the biggest takeaway. FNV was Franco-Nevada, but great buy and hold precious metal. That's correcting a little bit. FCX is also correcting. It's correcting 10% while in an uptrend. So the corrections matter and the strategy matters. Guys, let me know where I got it right, where I got it wrong, what I'm missing, what you think I ought to talk about that I'm not talking about. You can leave those in the comments. That's the best place for that. And if you like this video, you're going to love our other videos. Okay, thanks for being in my world, and I will see you on the next video. Bye.